Explainer. Today, we're looking at the great consumer credit shift of 2026. This is a massive, honestly seismic shift happening right now in the consumer credit landscape. For decades, the way we spent money and borrowed money felt pretty set in stone. But those traditional spending habits, we are fundamentally breaking down. We're seeing a complete fracturing of how people pay for things, and it's literally splitting the market into two entirely different directions, all depending on your financial footing. To really get what's driving this shift, we first have to ask ourselves a question that's causing a whole lot of wallet anxiety right now. Is the exhausting game of premium credit card rewards actually still worth the effort? Think about it. You've probably seen the flashy ads for the latest, heaviest metal cards promising thousands in value, luxury travel perks, VIP status, the whole shebang. But underneath that shiny surface, a growing number of consumers are taking a step back and realizing that chasing these points has just become incredibly exhausting. The industry actually calls this the coupon book problem. And it makes total sense when you look at the hurdles involved now. Cards like the Amex Platinum or that new $695 Robinhood Platinum, they're effectively making you treat your personal finances like a part-time job just to break even. You've got to hit significantly higher minimum spends just to get the sign-up bonus. Amex bumped theirs up to $12,000 in the first 6 months. Then, when you actually try to use your points, the transfer partners are completely devalued. We're seeing airlines like Emirates or Cathay Pacific requiring way more points for the exact same flights, and banks are shifting to dynamic pricing, which is basically a black box. And those airport lounges you were promised? They're gating access now, requiring you to spend $75,000 a year just to bring a guest. Plus, you have to track a dozen different monthly credits, $10 here, $15 there. It's no longer a perk, it's literally an administrative chore. So it's really no wonder regular people are frustrated, especially when you look at the macro data. The average credit card debt has now blown past $6,000 per borrower. So while premium cardholders are busy playing this complex game of point optimization, the underlying system is actively punishing the average consumer who happens to carry a balance. If you're holding on to $6,000 in debt, absolutely no amount of airline miles is going to bail you out of the math that comes next. Compounding that pain, the average credit card interest rate is currently sitting at over 20%. And remember, that is just the average. At 20%, you're paying $20 for every 100 you borrow. And worse, your credit card interest actually accrues daily. It's not just tacked on at the end of the month. It creates this brutal debt spiral where making the minimum payments does absolutely nothing to reduce your principal balance. Okay, so let's break down the actual math here, because this is absolutely crucial. Say you spend roughly $3,000 a month on everyday non-travel stuff, groceries, bills, normal life things. That's $36,000 a year. A simple no annual fee card that gives you a flat 2% cash back, that nets you an easy $720 in value. But if you put that exact same spending on a $695 premium card that only gives you 1% back on non-bonus categories, you earn $360 in rewards. Subtract that massive annual fee, and you're actually sitting in a negative $335 net value. You are literally paying for the privilege of making your own life complicated. Financially stable consumers are doing this exact math, and they are fleeing the complexity. We're seeing a massive, simple card comeback. High-income households, the exact people you'd think would want those luxury cards, they're opting to switch back to set-it-and-forget-it cashback cards. They just don't want to align their lifestyle with a $10 monthly credit at a retailer they don't even like. They want transparency, zero fees, and some peace of mind. But that is only half the story. For folks who are financially fragile, there's a second massive shift happening away from traditional credit cards, and that is the total explosion of Buy Now, Pay Later, or BNPL. BNPL is essentially a point-of-sale microloan. It lets you split a purchase into smaller, bite-sized payments right there at the checkout screen. And the big draw? It generally skips the application hassle, there's no hard credit pull, and most importantly, it usually avoids that brutal 20% compounding interest we just talked about. To see just how fast this is building, let's look at Affirm's explosive evolution. Affirm is the largest US-based BNPL financier. They were founded in 2012 by PayPal co-founder Max Levchin and went public in 2021 during the whole e-commerce boom. But look at 2026. This is where it gets absolutely wild. They've evolved from a simple little checkout button for buying jeans online into a financial behemoth that's actively submitting applications to become a fully chartered bank. They're even piloting programs right now that let users split their monthly rent into 2 payments. And just to grasp the sheer scale of this, Affirm alone reported having nearly 26.8 million active consumers early in 2026. That is just one
company. They're processing a staggering $37 billion in annual payments. This isn't just some niche alternative payment method anymore. It is rapidly becoming the primary financial engine for a massive chunk of the population. However, a massive complication pops up when you look at exactly what we're financing. In the early days, BNPL was mostly used for discretionary spending, right? Fashion, a new TV, maybe a Peloton. Now, a staggering 40% of total online BNPL loan value is going toward groceries. Groceries. Only 12% is for electronics. This is a visually striking and honestly alarming indicator of consumer financial fragility. When nearly a quarter of American BNPL users are relying on microloans just to finance their weekly food shopping, it signals some really deep economic pressure. This shift toward financing everyday necessities is so concerning that even the BNPL companies themselves are having to answer for it. Following some serious public outcry over a partnership with the food delivery app DoorDash, a spokesperson for Klarna plainly stated, if people are in a situation where they feel like they have to put their food on credit, that's a bad indicator for society. Now, they argue it's a rational money management tool, sure, but those societal red flags are undeniable. Because look, while BNPL cleverly avoids that 20% compounding APR, it introduces dangerous new hurdles. We're normalizing taking on debt for basic survival needs. And there are real hidden costs here. To keep their default rates lower than credit cards, these apps basically force you to set up automatic payments. Which sounds great, right? Until you realize consumers are juggling multiple, overlapping microloans that automatically draft from their bank accounts. The Consumer Financial Protection Bureau noted this actively limits consumer choice. These autopays trigger out of nowhere and suddenly leave people short on cash for their rent or utility bills. And when they do miss a payment, bam, they get hit with aggressive junk fees.
And the data proves exactly who is really carrying this burden. Information from the Federal Reserve Bank of New York confirms this deeply troubling trend. 60% of financially fragile households used BNPL more than 5 times in the past year alone. People with limited access to traditional credit are 3 times more likely to use these services recurrently. They're stepping off the traditional credit card treadmill only to step onto a different and arguably much faster microloan treadmill.
Ultimately, what you should take away from this explainer boils down to one final question. As we witness this massive consumer shift, as the financially stable flee the exhaustion of premium credit cards for simplicity, and the financially fragile flee high interest rates for microloans just to buy groceries, are we actually finding financial freedom? Or are we just finding shiny new ways to mask our economic fragility? It's a question every single consumer needs to ask themselves before they swipe or click again.